We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Professor Joel Litman, President, CEO, and Chief Investment Strategist of Valens Research and Altimetry Research. Joel, thanks for joining me today.
Thank you, Tom. I've been looking forward to this. This is cool. Great.
Me too. I've really been looking forward to this. Of course, I had the pleasure of meeting you at the Rule Investment Symposium, the Rick Rule Investment Symposium. And, you know, I was really struck by your talk. And I immediately, as soon as you got off stage, kind of had to run over and introduce myself. And I really wanted to. That
was cool. Thanks for doing that, man. That was cool.
Absolutely. You know, I do my best to try to look at the other side of the coin, to find contrarian thinkers, as I always find it's valuable and really important to challenge the echo chamber and consider the other sides of many of these situations to see, you know, all of these situations that are unfolding in the world today, to try to look at it from all sides. So I think one of the most stunning parts of your presentation at the conference was how you laid out the case for continued strength in the US, despite the headwinds that we do currently see. So why are you, as you put it, the bearer of good news?
That was my opening remark at the conference. I'm sorry to be the bearer of good news, because gold and other precious metals do better when there's bad news. Generally speaking, bad news for the dollar, bad news for the economy, bad news for global crises. That is when gold historically has done well. And I knew that it was a gold crowd, so I was saying, I'm sorry that I've got a lot of good news to share. It stems from, though, the reason I'm at that symposium and the reason, we are at some level kindred spirits is we have an absolute mistrust of the financial system. We call it the Wall Street financial media industrial complex, this super echo chamber of what Wall Street says, and then CNBC and Bloomberg parrot, and it comes back around, and Wall Street research says something else, and they talk and act like any real investor worth their salt would ever pay attention to Wall Street research. And they're all using financial statement analysis, produced by an accounting regime, which is the most incestuous, right? I'm saying this is a CPA who started in public accounting in 91. When you look at over, the last 34 years, 33 years that I've been in public accounting in some way, shape, or form, the financial statements do not at all provide insights on what's going on. And so when we want to understand what's happening on global macro, we want to look at all the companies. We want to look at all the companies within a country, look at the profitability, look at the growth, whatever, and question what is being told to us, right? And what you find is that GDP is a horrible metric of economic power. It measures transactions, but it doesn't measure is there power. I mean, countries are not, you go country by country, countries are powered by taxes, not by GDP. And they would say, well, isn't there a relationship between the two? I'm like, well, it depends. US corporate taxes come from, a large chunk come from companies, and those companies generate income that is almost 50% not from the United States. Most countries in the world, that's just not the case. Or if they export and they don't actually make money. They make just enough to pay their salaries, but there's no income. Well, if there's no income, there's no income tax. If there's no income tax, there's no power. And that was the point I was saying, is that when you look at the US with a much lower tax rate than most of the developed world, right? Now, someone might say, what about Singapore? I'm like, okay, not including a country of, that's a city-state country that's this big, right? But any major developed country, I'm saying developed or emerging, Russia, China, whatever, the US has a lower tax rate and yet collects so much more in taxes on a lower tax rate, including the Trump tax cuts, because the American companies and American people have so much income, so much more income than the rest of the world, more corporate profit in the United States than the rest of the entire world combined. US companies generate more corporate profit than the rest of the entire world combined, which is why US companies trade at a higher valuation than all the rest of the world's companies combined. Well, what does that do? That creates a tax base for the United States that is bigger than the rest of the world combined. Mm-hmm. And when you think that countries are run by taxes, that says the US can actually continue to have a lower tax rate than other countries and generate so much in tax that things like the national budget, national debt, are not the problem that people think. They'll say, well, let's look at debt to GDP. And I'm like, GDP? How does a country take GDP and pay off its debts? It can't. Countries pay their bills with taxes. And when you look at, what's somewhere between $4.5 and $5.5 trillion, that's an estimate for the next couple of years of annual U.S. tax revenue. And I think it's a fair estimate. You're looking at a total debt service that's $1 trillion or sub $1 trillion. And what planet would you say that a country that's generating $5 trillion can't pay off $1 trillion in debt? Which is why that debt is so oversubscribed every time the U.S. issues more debt, right? And that's at 5% now, or 4.5%, or whatever it comes in at. Mm-hmm. And we're talking about the Fed probably lowering rates, right, over the next couple of years, which means that debt service for the U.S. national debt will probably come down a little bit. And that's just the national debt alone. So we're saying, no, the U.S. is not at risk of going bankrupt anytime soon. Now, I don't want where we do share feelings on this, me and the audience that we were at and others of your audience, is that I don't believe the politicians should hear this statement, because they'll go out spending like more, drunken sailors, right, on temporary beach leave, and just spending everybody else's money and spending it like there's no tomorrow. Whereas if you say, hopefully we get some discipline, there is enough attention to keeping the deficit down, you don't have to have a balanced budget. If the increase in U.S. profitability of companies, in the U.S. incomes of people, and wages keep going up, well, then there's every reason that taxes will continue to rise on low tax rates. Mind you, not on raising taxes, raising tax rates, on continued tax rates, including the Trump corporate tax cut, that you would continue to have enough money to fund the deficit. When someone said, well, what if the U.S. takes out another $1 trillion of debt, right, in a deficit? I said, well, what's the debt service on that? I could do the math. So let's say it's 5%, which it isn't, it's a little lower, but let's say it's 5% on $1 trillion. That's $50 billion. So to cover an additional $1 trillion of deficit costs the U.S. $50 billion. Well, on a tax base that could be as high as $5.5 trillion in the coming years, $50 billion is nothing, meaning the U.S. could literally afford to have that. Now, if they're using that money as just handouts, handing it to other countries, spending it on senseless wars, using that money to give away business loans to companies during COVID that were perfectly fine, and then took that debt and bought Lamborghinis with it instead of actually using it for their payroll, which there was a lot of that going on. Mm-hmm. That, of course, will be hyperinflationary in and of itself, or I'll say super inflationary for that time period. But when you start balancing all these things, you're like, no, the U.S. actually is in an awfully good situation. The rest of the world, not so much. What's interesting is everything they say about the U.S. being over-indebted, that is the problem in China. That is the problem in Russia. That is the problem of many of European countries still. That is not the U.S.'s problem right now. And just good, solid credit analysis would show you that. You just can't do that based on GDP or based on, these big headline numbers that the financial media knows will get clickbait, but isn't based in reality of good credit research.
Mm-hmm. So, Joel, if we could, can we dig in a little bit more on why, let's say, net earnings are such a misleading figure, and what is actually a better analysis tool?
Well, imagine if the regulators running the casinos were basically a revolving door with everybody inside the casinos. Let me say it another way. Imagine if the FDA was a revolving door with the biggest officers of the biggest pharma companies, who then go back into the FDA, who then go back into the pharma companies. What do you think ends up happening, right? Well, people think that, well, accountants aren't like that. If you looked at the revolving door of the accounting firms and the accounting regulatory body, and how incestuous, I'm using that term, it is the absolute example of regulatory capture. I'm quoting George Stigler, Nobel Prize winner for economics, or the Economics Prize of Nobel. It's not technically a Nobel Prize, but either way, the Economics Prize. George Stigler said, regulatory capture is when you end up having less competition. And that's when the incumbents start creating the rules. you kill competition. So when I started, there was a big 8 accounting firm, right? Big 8 accounting firms. And there are a whole bunch of large middle tier firms also, like all over the country. Today, there's 4 accounting firms only. You really can't go below 4 because then you don't have any competition. And even the middle tier firms have consolidated, so you really don't have a lot of choice as to who to go to if you need a big accounting firm. And then you look at who's running the accounting regime, the Financial Accounting Standards Board. It's the same people. It's not like they've gotten some experts from outside. No one's asking me to come in. When you look at the pedigree and the resume of the people studying this stuff, it's straight down the line, Big 4 type accounting, right? And what have you. And are they in the business of thinking they should simplify the accounting rules, right? In fact, they allow one person, they say it from industry. So in any 7-person FASB board, they always do purposely bring in someone who's like a CFA or someone from industry. And when you look at the voting, which is, by the way, not unanimous voting on new accounting rules, it's a simple majority. When you look at who's dissenting, every single time the dissenting voter is that CFA, the non-CPA who says, I think this rule is bad. I think it's to be too complex for individual investors to understand. I think it's too complex for others to understand. And they always, I can go back like 20 years and show you this, right? Where they get overridden. They get overridden by the, rank and file CPAs who stayed within their lane, unlike me, in building financials. So when we looked at that, I said, no wonder the CPA exam was so difficult, because nothing in it makes sense. It's not logical. The stock options analysis doesn't make sense. The lease capitalization doesn't make sense. The fact that U.S. companies are punished for innovation, they're forced to a 100% expense R&D. Well, that punishes innovation, right? It says, but the Europeans are saying, no, you should capitalize investments. In fact, Accounting 101 says you should capitalize investments, but U.S. companies don't. They're not allowed to. So they have to expense R&D. Well, that punishes innovation. Now, thank goodness we have a phenomenal angel investing, venture capital, microcap ecosystem where people say, hey, I will understand that R&D making your earnings negative is not really making your earnings negative. It's just you're taking earnings and you're investing. Well, I don't know if most individual investors understand that when they look at a price to earnings multiple, that when a company says, we're going to invest in the future, earnings that year will collapse. And a lot of companies don't want to put up with that. So no, the accounting has done a disservice. I think the entrepreneurship of the American population has found ways around it. And that's us. So one of the things we do is we produced a uniform accounting module that says we're going to use the same uniform accounting. We're going to do what any sensible person would ever do, which is to capitalize things like investments, as opposed to expensing it all and making a company take a hit this year for revenues they won't create for another 2, 3, 5, 7, 10 years. The pension accounting is maniacal. I can't even get into it, but CPAs constantly fail that section of the exam because as much as they study it, they're like, I don't understand why pension accounting looks the way it does. And there's still 300-400 giant companies in the US with giant pension numbers that don't make any sense. Make any sense. So yeah, a lot of open or exposition, but you fix the accounting, you get to clean uniform earnings, and that's what our clients use us for. So we have 230 to 300 biggest money managers in the world seek out our uniform accounting numbers, not because they're saying we want to rely on you in our stock picks per se, but because they're saying we want your clean data so that we have that in our process. Now, that said, we've got, Altimetry, we've got individual investors who say, hey, if you have that, will you tell us what stocks to buy and sell? And out of our database of 32,000 companies, I'd say I have no opinion on 31,970 of them. But 30 of them, that 0.1% maybe, right? And some days I feel like it's 0.01% of the entire database. Something will jump out of us that says, hey, here's an interesting stock to buy, or here's a great bond. But for the most part, our job is to clean up the accounting for the public to use, and it's called uniform accounting. So without that, you can't do macro analysis. You can't say if the stock market is expensive. I mean, for people who are saying right now that, the stock market's trading at a really high price to earnings multiple. I'm like, are you using the earnings as calculated based on the FASB rules? They're like, well, yeah. I'm like, well, then it's wrong. All right. Warren Buffett says, don't ever use net earnings. His teacher, Ben Graham, said, you have to adjust net earnings. Charlie Munger says, don't trust the accounting at all. Marty Whitman, God rest his soul, said the same thing. BlackRock constantly talks about earnings quality, that you've got to look at earnings quality. Why? Because the earnings do not have quality. So you've got to put quality into it. They don't call it uniform accounting, but it's uniform accounting is what BlackRock's doing. And so every great investor is doing this. And yet someone on CNBC is going to say, oh, the price to earnings ratio is at the highest level. I'm like, is it? Are you using an E that's being calculated differently than it was 5 years ago? Because it is. And it's different than it was 20 years ago, because it is. But you're going to then take the price. I'm not arguing with the price. The price is the price. But you divide by price into earnings and you walk away saying the stock market's expensive. I'm like, well, tell me you have the right earnings number and then I'll believe you. Yeah. And that's where the conversation stops. So that's our job on getting to a better earnings number, and why you can't trust the FASB earnings regime that exists. It's a bunch of nonsense. Financial statements as they are published today.
Well, I think there are a litany of examples of, this complexity that is introduced into these systems so that normal people don't necessarily or can't necessarily understand on a surface level. When you take the example that you gave and you actually realize, there's probably a better system of doing this, of getting an objective metric on valuing whatever company or country you're looking at. I think that's extremely important. And it's not necessarily always as complicated as it necessarily seems, right?
Yeah, it's funny. It's on one level, we've counted about 130 adjustments that might need to be made when you look across 32,000 companies. But the number that actually matter per company, it's usually like 5 to 7.
Yeah.
5 to 7 adjustments till you get back to reality. Like, okay, get rid of this item, fix this item, add this item back, and you've got a very, very, very good earnings number. The problem is it's a different 5 to 7 from company to company, and sometimes it's a different 5 to 7 from year to year, because companies will change their accounting elections or a new accounting rule will come into place. So yes, it's simple in terms of, at the end of the day, it may only be 5 to 7 adjustments that matter, but you kind of have to go through the entire checklist of 130 to say, oh, did they trigger one of these? No. Did they trigger this one? No. Was this an issue? No. And then you hit when you're like, oh, that wasn't there last year. Well, they took a really special accounting adjustment this year when they made that acquisition. They wrote off a ton of goodwill that I don't know if that's the right way to look at it. And you've got to fix that item before you can get to a real earnings number. Right. But yeah, if you don't do this on an individual company basis, how can you look at individual company valuation, right? When earning power is what they're all about. If you don't do this for 6,000 US companies to get really the Russell 3000 plus everything else, right? Really 6,000, which is what we're covering in the US, a little more than that. How can you know what is going on with the US economy? If you, based on what? There's an earnings recession based on GAAP earnings number. Well, is that real, right? Or is it not? That's, what we feel is necessary. And you're right. It is impossible for an individual investor even to look at one company. The financial statements may say, here's the balance sheet, here's the income statement, here's the statement of cash flows. And then below it says, the notes are an integral part of these financial statements, meaning you really can't understand them without looking at the notes. And then the notes are 350 pages. 350 pages for some companies. Citigroup, I think the notes in the financial for Citigroup are literally 1,000 pages in the 10K. On what planet is someone going to be able to look at Citigroup and say, you know what, I'm going to analyze this company and see if it's a buy, right? I'm going to pour through 999 pages of notes to then understand what the meaning is behind each of the balance sheet income statement items. Who could possibly do that, right? So BlackRock's doing it, and they hired 15, 20 people like me, professors of accounting, professors of finance. I spent a little time flirting with going to BlackRock at a couple of points in my career, but I didn't want to get stuck in another big giant organization. I was at Credit Suisse at the time. And I said, no, I think we're going to launch this boutique, and a bunch of us left and launched this thing 15 years ago. That's Valens Research and Altimetry Research.
So Joel, is it maybe an imbalance or the incentive structure that lies beneath that company's profitability or the way that they want to report their earnings? Is it the incentive structure that drives this complexity and this misleading information?
Yeah, I would say this is a case of don't hate the player, hate the game. I believe most CFOs, and I believe this. There's been good surveys done of CFOs who say building their financial statements is an act of compliance, meaning it doesn't really help me manage my business. It doesn't tell me what's really going on. Almost every company's financial statements now say, I'm adjusting earnings, I'm adjusting the assets, I'm adjusting the balance sheet in some way for purposes of the actual incentives that they use. Right? And they say the way we monitor a business, the way we manage our business, the way we pay our people is not based on GAAP accounting because we think GAAP. Now, there are a few companies out there that still think that's the case, and by and large, those are not well-run businesses, right? In the annual proxy that companies file every year called the DEF 14A, the DEF 14A, any lister in the United States, any public company listing in the US has to file a DEF 14A. And that DEF 14A, they say, here's the metrics with which we run our business. Here's how we get paid. All right. If we do this well and this metric goes up, we'll get paid. Well, if they're using straight up EPS, you will find disincentives for building the business correctly because they just start managing to an accounting number, which is a bunch of nonsense already. Right. So if you take the 30 great, Seth Klarman is like analysis of reported earnings will mislead investors into the true profitability of a business. This is Seth Klarman, one of the greatest investors ever. Jean-Marie Eviard was asked at a CFA program in New York. They said, do you restate financials when you're looking at companies? And he was like, he said the word, he said, always restate the financials when you want to value a company. Right? And yet, what does CNBC do all day? Oh, here's the earnings number. Did they beat that earnings number? Did they miss the earnings number? And you're like, so it's a nonsense number that every great investor knows is nonsense. And yet the Wall Street research reports are all based on that nonsense number. Their estimates are based on a nonsense number. They talk about missing or beating a nonsense number. And you wonder why an individual is supposed to be able to make heads or tails of that and be able to invest and do well, right? They can't, right? Not in the general stock market.
Right. So now that we've understood, let's say, the problem that we're facing here, let's zoom back out and understand how that ends up affecting the US tax base and also how the US actually taxes globally versus most of the other countries in the world not taxing that way.
So if you get the biggest companies meaning the 6,000 biggest companies in the US, you have a microcosm of corporate America, right? Because by the time you even get to the bottom 3,000, I think the bottom 3,000 together are probably less than 1 or 2% of the top 3,000, right? So you're getting some tiny companies. So even at 6,000, you're saying, all right, we're getting a full breadth of understanding of what's going on. You could do that in China. Believe it or not, Chinese companies will, when they file financial statements in the US, they will readily and have been found to readily lie. There's a great movie called The China Hustle about just how many companies were listing in the US, but they don't lie to the SAIC, basically the SEC of China. They might lie outside, but they don't lie internally. And the SAIC to this day still makes Chinese financial statements available. So get those financial statements, convert them from Chinese to English, and you actually have a good understanding of what's really happening in those companies. Well, if you take that for China and you look at those 6,000 companies, you find that in total, maybe their true economic profit, maybe, is $100 billion. Economic profit, $100 billion. So even if they tax...
Sorry, is that for all of China?
That is for all of corporate China, public listed companies. Mm-hmm. That is getting all the big firms and everything else. You're looking at $100 billion. That's it. $100 billion US dollars. So let's say their tax rate on corporations was 100%, which of course, if you do that, you crush the company's ability to ever raise capital. They can't make debt payments. They can't whatever. But let's see, you take all of their economic profit, which again, it's Chinese accounting standards. So you have to convert to uniform accounting. So you're apples to apples around the world. Well, that $100 billion is what can feed the tax base of China. US corporations right now are generating something around $1.5 to $1.6 trillion of economic profit. So for the US to say, all right, we're going to tax you at 20% on the Trump tax cuts, right? And collect from you, I don't know, $400 billion, $500 billion, $600 billion just from corporations alone is nothing. It's easy. And that doesn't crush the companies in the US because they're so profitable. They can then take the rest of that money and invest it in R&D or give it back to shareholders in dividends or put in share buybacks or make strategic acquisitions. Chinese companies don't have that flexibility because they're not profitable. So big does not mean good. It just means big. And Chinese has very, very big companies and they're not earning a profit. They just aren't. They aren't. Second piece of this, you start looking at corporate debt, right? And the health of companies. We run this thing called intrinsic credit default. But essentially, it's a default score. And if you do uniform accounting, you do very good credit research and credit analysis. You say how much debt is due over the next 5 to 7 years, and how much does this company generate in cash? What are all their obligations? And do they have a cushion, right? Do they have 5 to 1, 6 to 1 ability to pay off their debts, or it's like 1 to 1? Well, when you do that calculation and you look at all companies in the United States with debt that you can get their financials on, right? Which is, again, a good representation of the United States at some level. It's certainly a great representation of the stock market, right? You end up seeing literally 1 out of 100 companies, 1%, has some debt issues, may not be able to pay their bills, may go bankrupt. That's 1%. All right. That is unbelievably low. I'm not saying they even will default. We're saying that they have some risk of default where you can see that their debt service levels are kind of matching or maybe even slightly above or well above their cash flow generating ability. All right. You do that analysis in China, it's 34%. 1 out of 3 Chinese companies is at risk of massive bankruptcy. And I say massive, meaning it's not just some little bankruptcy court and we can just get out of it or whatever. It's bankruptcy, meaning I can't pay my debts. I got to fire people. I got to shut down. It's that level of crazy. And then we're talking about the biggest companies in China that should have the backing of the government and everything else. And there's still 1 out of 3 at risk of complete default. Well, what happens when a company defaults? Do they pay taxes? No. Are they able to hire people? No. Are they able to pay wages? No. Well, then what happens? All the wages of all those people at all these companies that are on the verge of bankruptcy or actually going bankrupt right now as we speak. I say bankrupt because they don't have the bankruptcy laws in China the way we have in the US, but they're going into default. They're not paying their debts back, which means they're at trouble of paying their own people and whatever. Well, what happens to incomes? Personal incomes. Well, you can't tax people that don't make money. Right? You can't tax people that are unemployed, and you're getting this massive level of unemployment that's flowing through China. That is not the case in the United States, where wages are up. Now, people complain because, yes, but inflation's up. I'm like, yeah, but for the most part, wages are up. Unemployment did tick up last week, and we are watching it, but these are some of the lower unemployment levels of the entire planet, right? At these mid-single digit percentages versus so much of the rest of the world, which is clearly double-digit percentage unemployment. So you'd say, so if most of the U.S. is employed and U.S. wages are bigger than the rest of the world, right? Americans do make more money. Again, don't kill me because someone mentions Liechtenstein or Luxembourg and says, oh, they have higher. I'm like, all right, pick out a country of 3 million people, fine. But in a country of 300 million people, any other country even close to that, 50 million, 60 million, 90 million, does not have the income that the U.S. has. And so the U.S. is able to, honestly, in a lower tax rate, it doesn't feel like it as an American. I mean, right? But it is a lower tax rate than in China, than in Russia, than in any communist country for sure, right? And in much of Europe, where you have a lot of socialist countries, and in Latin America, you have socialist countries, meaning let's tax people more. U.S. Americans are actually taxed a good chunk less than you see this, particularly at higher incomes. And yet on that lower tax base, they can collect another $1 trillion or $2 trillion of taxes on a lower rate, because the tax base is so big, the U.S. can collect that. Well, when you start looking at people saying, because I do work with the Pentagon, and one of the questions they ask is, well, we're worried about these budgets in China and how much, like China doesn't have the money to fund and keep up with the U.S. military budget. And they're like, yes, but the U.S. military budget is bigger than the rest of the world combined. I'm like, well, that's because U.S. corporate profits are bigger than the rest of the world combined. U.S. taxation in dollar amount is bigger than the next 20 countries combined. And give us a few years, and you're looking at the U.S. collecting more in taxes than the rest of the world combined. I mean, when you think about this is Pax Americana. It's not give me a ranking of the world and it's U.S. and then China and Japan or Germany or U.K. or whatever else. It's the paradigm I think of is here's the U.S. global economy. And there's every other country is either a satellite off that and doing okay, or is separated from it and getting destroyed economically. You're either with the big player or you're not. It is a complete reglobalization of the world, less Russia, less China, right? Less, name every other communist country, less a number of the socialist countries, and the developed markets, what they call the West, but the West includes Japan, includes South Korea, it includes, right, Indonesia, Philippines, Singapore, the Southeast Asian nations, Australia. So it's not the West per se, right? It's developed world. All, when you look at MSCI developed markets, they're all US-based countries, US trade, US shipping, US defense, US oil and gas, you name it. And in that scenario, the US is going to lose. The dollar is going to stop being the reserve currency anytime in the next 10, 20 years. It's just crazy talk. Once you see that level of data, right? But yeah, if you're looking at GDP, you're like, oh, China's going to take over in GDP. Let them. Because if they have one giant country GDP with no profit and low incomes and still massive unemployment, are they a threat? Not really, because they can't fund their military. They can't fund their Belt and Road initiatives right now. They're pulling back on every one of their Belt and Road initiatives, but China's still a threat. There is no threat to the U.S. hegemony, right? The U.S. Pax Americana is in full swing, and we're going to be looking at that probably at least through our lifetimes, Tom, and maybe probably our kids too.
Right. Joel, you mentioned to me, you and I had a chat the other day, kind of preparing for this call, about the amount of talent that's leaving China as well. The amount of wealthy, affluent talent that is actually stifled in a way by China, whatever you want to call it, tax rates, censorship, any metric you want to.
A freedom score that's one of the lowest of the entire country, the entire world, right? That's objectively speaking.
Mm-hmm. I think that really plays into this as well, right?
Absolutely. Look, I mean, what the U.S. has going for it, despite all the problems, all the issues, and people, I have been asked, what would make me change my opinion on the U.S. having this power, this economic power, and it's if there was a rescission of the Constitution and the Bill of Rights. But thank goodness the U.S. is not a pure democracy where 51% of the people can get together tomorrow and say, I'm getting rid of the First Amendment or the Second Amendment or the Fourth Amendment or the Fifth or the Sixth or the Seventh or the 10th. I could go on, right? But those are the reasons that every rich person or entrepreneur or saying, I want to make it big, comes to the United States. Because you have free speech, you can have entrepreneurship. The idea that you could have entrepreneurship in China, but you can't have free speech is like, okay, you will, right? I'm going to say it was a Russian accent. You will innovate. And it's like, okay, I will innovate. And you'll do it here the way I tell you. That's not how an entrepreneur thinks. Entrepreneurs are like, I'm going to take down the big guys. I'm sick of GM owning this. I'm tired of the big banks owning this. I'm tired of whatever else. And Elon Musk, right? And all the great entrepreneurs, right? That have come up and said, I'm going to take down the regime. Well, you can't have that in China when the regime is all state-owned companies. So what happened to Jack Ma when Jack Ma says, the banking system is antiquated, we're going to fix it, I've created Ant Financial, it's amazing, and then he basically almost died. He disappeared for 3 months. He missed his own TV shows. They shut down his university. They didn't care that the students there had already been there 3 years about to graduate. So Jack Ma created a university kind of like Babson, this wonderful entrepreneurial, free thinking kind of university. Well, they didn't want that, so they shut that down unsurreptitiously, gone, right? He didn't show up on his own TV show for the final 3 episodes. It was his kind of version of The Apprentice, right? Where he was one of the big judges, kind of like Trump's apprentice. And now today, what does he do? He's quiet. He doesn't say a word. It's like his tongue got cut out, figuratively, right? I'm sure it was threatened literally, right? But he got cut out figuratively. So when you look at that, you'd say, so what does the wealthy of China want to do? Well, last year, something like 13,000 multimillionaire families were able to leave China. Well, no, they weren't. Nobody was entering China with that kind of wealth, right? And Russia, how many people left Russia? Several thousands of multimillionaire families left Russia, let alone, anyone who's making 50 grand, 80 grand, 100 grand. China's tax rate, once you hit $140,000, 850,000 renminbi, once you hit around $140,000 of money, of income in China in a year, you start getting taxed effectively at about 80 to 85%. So why bother working past 140 grand?
Mhm.
I mean, who wants to? Why bother saying I'm going to go make $5 million, right? And I'm going to keep a few $100,000 of it, and the risk that I have to go through to create a new business. You know what? Just let me be a worker. So you're breeding a country of workers, and anyone who wants to be an entrepreneur says, I'm getting out of here, both for the ability to be an entrepreneur and what happens if I'm successful as an entrepreneur. So when you start looking at that, right, you understand why, right? When you look at this flow chart, if you will, why does the US have the most profits in the world, which also leads to having the most employment in the world? It's because half of the biggest companies in the US were venture capital backed somewhere in the last 30 to 40 years, right? Buffett did a wonderful thing 2 years ago, and he said, let me show you the biggest companies in Japan 30, 40 years ago. Let me show you the biggest companies in Japan today. Guess what? Same companies. Let me show you the biggest companies that you could do this country by country, right? It's almost always the same companies. The United States, not one. GE is no longer at the top of the list. IBM is no longer at the top of the list. Merck is no longer at the top of the list. And these companies get replaced. And who do they get replaced by? By entrepreneurs who've turned their companies into gigantic multi-billion operations, hiring lots and lots of people. That doesn't happen in the rest of the world. It's just, all right, it happens in Israel, but Israel's the size of New Jersey, all right? And Israel's basically doing and copying what the US has been doing, which is what gives you, people say, how does Israel have so much money? Well, they've created an ecosystem for entrepreneurs to want to come in and do these things. So when you say, so where do the biggest companies come from? They come from venture capital. Well, where does the US have a lead on that? Meaning, how can I make a 30-year forecast? Because 30 years ago, you could have made this forecast. What do I mean by that? Currently, right now, US venture capital is 2/3, meaning of the entire world. Let me say it a different way. It's 2 times the rest of the world combined. US VC is 2 times the rest of the world combined. US angel investing, 5 to 10 times the rest of the world combined. And you're telling me these other countries are suddenly going to just force innovation inside Russia, inside China, and suddenly China's going to become some powerhouse economy when no entrepreneur wants to stay there. The wealthy are leaving there every day. And then where do they want to go? They want to go to Dubai. They want to go to a couple of countries in Europe. They want to go to Australia. And they really want to come to the United States. And the reason is the opportunity of the US, and because of the Bill of Rights, which still is being enforced, allows you to have free speech, allows the government not to come in and take your stuff, allows you to have due process. And I know people say, oh, but let me show you this example. Any example anyone's ever showed me about the US violating the 4th Amendment, the 5th Amendment, the 6th Amendment, the 7th Amendment, I'm like, it's a heck of a lot worse everywhere else in the world. You think you have free speech in Great Britain right now? Absolutely not, right? You do not have free speech in Great Britain. Yeah. Right? They have free speech. And of course, you don't have it in Russia, China, or the other communist countries, but you still don't have really free speech in Germany the way you do in the United States, right? That you'll get shut down, you'll get canceled, you get whatever by the authorities, not just by the general social media. So when you have those things in place, it is possible for us right now, Tom, to say objectively, 30, 40 years from now, the US will have the most dominant economy. And they're like, how do you make that judgment? Because the seeds of a dominant economy are in entrepreneurship and venture capital. And right now, the US is continuing to grow that. It's expanding its dominance in entrepreneurship and venture capital and angel investing and you name it in entrepreneurship, which you just don't see anywhere else in the world, with minor exceptions, Singapore, Israel, right? Where they can manage a country of 3 million and 6 million or 10 million people or whatever else. So versus 330 million people cranking, right, in the US on building that economy. So no, we can make that 30, 40 year, and you just have to look at the numbers in a clean way, right? Uniform accounting wise, and start saying, why does the US have such power? Why does it able to collect such taxes? Why does it have such low unemployment? And they all truly stem from it being a constitutional republic with a Bill of Rights and all the amendments that went with it that make the US, the greatest experiment on earth for all its faults and issues and whatever people I might want to point to. And I'm in agreement with them, because every time someone threatens the First Amendment, I get scared, but then something happens. So recently, Elon Musk published that Kamala Harris video, whether you like Kamala or not. It was a funny video, right? I mean, it was objectively funny that they plugged in all these. It made it sound like she was saying she was incompetent. It made it sound like she was saying, she was, and whatever else. Fine. But Gavin Newsom, and I think this is more important, said, I'm going to ban ads like that. I'm going to ban people from doing those kinds of things. And Elon Musk quickly tweeted back and said, in a very, very funny way, which you should look it up because I don't want to say it for your viewers, but in a way that was a very funny way. He said, I've conferred with noted authority on this issue. Parody is free speech, First Amendment protection, right? And if I want to make fun of Joe Biden or I want to make fun of Donald Trump, I can do it all day long. Or more importantly, if I want to make fun of the accounting regime, or if I want to make fun of the financial regime or the banks, I'm allowed to do that in the US. Not allowed in China, not allowed in Russia, not allowed in, frankly, a lot of European countries, right? They'll say, no, you're not allowed to say anything bad about that. You can't. I mean, as of right now, you still can't even video parliament, right? In Great Britain, don't tell me they have free speech, all right? And when you look at Brexit and the problems that they're having, you could say the more any country gets away from the Bill of Rights, right, certain unalienable rights of the Constitution, the more that any country gets away from those things, the worse the economy becomes. You're like, why? Because you're telling your smart, creative people to leave, right? Versus the US, which is still saying, smart, creative, whatever, come on in. I mean, the border's allowing anybody in right now, but I mean, ideally, there's some smart, creative people coming in too.
Yeah. I think that point that you make that's very important is, despite all its pitfalls, there are still a lot of things really going for it. I mean, the saying that comes to mind is cleanest dirty shirt, right? Relative to a lot of these other countries, there's a lot of great things about the US. But, you mentioned Warren Buffett a couple times.
Yes, sir.
And he recently moved, I think he sold something like half of his Apple position. He's moving more and more into cash and treasuries. So how does that square with this, unbelievably strong stock market in the US? Like, how do we kind of square what he's doing versus what the reality of the situation is?
Well, I mean, the fact that I say that Pax Americana is in full swing doesn't mean we won't have fits and starts. So nowhere there am I saying there couldn't be a recession. Right. Nowhere there am I saying there couldn't be, bear markets and pullbacks over the next 30, 40 years. Of course. Mm-hmm. All I could say is, and I think Buffett is thinking this, is that if there were a bear market coming up soon, if there were a recession and stuff were cheap, I'd like to have some dry powder to go and buy up that stuff like crazy. Meaning, it's not a bear market, the world's going to end, go buy gold. It's a Buffett going, I might have some bargain opportunities again, like I did in 08, right? In 09, to just snap up Goldman Sachs at really cheap prices, get a bunch of preferred warrants and everything else because I've got the cash. So the fact that he's sitting around looking for, these opportunities, given the stock market, has hit some highs, I don't think it's anywhere near as expensive as people say. But do I think that we could easily have a stock market pullback? Of course. All right. Right now, our recommended dollar cost averaging, if this sounds short-term bearish while being long-term super bullish on U.S. stock market, is 18 months. Right. So we're saying, we think if you had money right now that it's in your 401k and you're not going to spend it for another 10 plus years, it should be going into U.S. equities. Call it VOO or SCHB or the SPY, just the general S&P 500. And people are like, well, that's a very bullish statement. I'm like, yes, but I'm saying spread it over the next 18 months, right? Which is a little bit like saying, what Buffett's doing, which is let me pile up some cash. Now, Buffett also, he's not just buying VO, he's looking for some big opportunity where he can buy some big giant company, right? In a way, Buffett today is more like private equity because it's private equity in public markets. When he's buying something, he's buying such a giant chunk of it, right? And he's taking such a big beneficial position. That's not like what he used to be 50 years ago when he was a stock picker and could just get in there, buy the stock, let it go up, sell it, buy another stock, let it go up, sell it, right? He can't do that now because he's the best beneficial owner and he's super concentrated positions. In many ways, he has to function a little bit more like a PE person or private equity person. And I could see why someone who thinks that way would say, all right, I might get some opportunities, some big ones, and I'd rather pile up some cash right now and take some of my profits off the table and give it a year or two and see what happens. And my parlance, give it 18 months, right? And so, for the individual investor, if you've got a 401k and you're not going to touch it for 10 plus years, it shouldn't be in a balanced fund. It shouldn't be in a bond fund. It should be in 100% US equities. But moving into US equities should take 18 months because we might get a gift. And by that, I mean, we might get a market pullback where we're like, all right, back up the truck. Tom, in March of 2020, you can look at my LinkedIn for goodness sake. April, May, June, and then June, I think, or June or July, I published in Forbes of 2020. We said, we think you should be putting money in the stock market. And our dollar cost averaging period was literally 3 months, which technically, if you think about it, is 2 months. It's today, a month from now, and a month from now. And we're like, back up the truck, right? This is the time to do it. Partly because we got that gift. We may get another gift, right? And if we do, why not just spread your money over 18 months? And if we get that gift, boom, you're in. If we don't get the gift, the market just keeps kind of going up with some volatility. Well, then at least you're in for the next 10 years. That's the best recommendation we give for our individual and family investors who are subscribers of ours, of which we've got, tens of thousands. So that's as important to me as coming up with the right stock pick, is saying, but what's the right asset allocation right now? And I think that jives with what Buffett's doing. Once you realize Buffett has to do things in a much more stark way on both ends, right? Meaning he might be piling up a lot more cash than I would recommend for a family or an individual. But then when he invests, he's able to go and buy 30% or 50% or 100% of the company. Which of my clients has the ability to do that, right? Only the biggest funds. So no, I think it's consistent, Buffett's piling up cash, with us saying 18-month dollar cost averaging in. And yet he's piling up cash to buy American companies. He isn't going out and buying up gigantic chunks of Asian companies or European companies or whatever else. And the reason is he says regularly, don't bet against America long term. Short term, should we expect pullbacks? Of course, they come and go. All right. And for me to make a prediction of when that would be just like, who knows?
Yeah. Right. I think that's, that nuance is so important to understand. We can kind of cut and take some of these comments out of context, and the value comes from actually listening to the entire explanation instead of just, the dollar cost averaging or, any of the pieces, the individual pieces of what you just said. It's so important to be able to have this long form discussion to really, and I think even, play back this discussion to really understand, again, how you're actually seeing this stuff. Joel, we've talked a lot about these misleading numbers.
Yeah.
What do you think, how do we operate in this world where we see, maybe a misleading jobs report or inflation number, CPI number? Like, how do you look at all of these different metrics to actually try to understand, as from this uniform accounting standard almost, how do you look at these other numbers to be able to get a real picture of what's going on in the world? I think a great example is, understanding jobs reports where you have unemployment down technically, but that doesn't include, let's say, full-time job loss going into 2 part-time jobs where you don't have the same benefits at the end of the month.
It's a great question. I'd have to come back and say, what is the job to be done? Meaning, what is the question that you're really asking? So let me say at one level, the stock market and the US economy are not the same thing. Not when 40 to 50% of the stock market's revenues come from outside the United States. Well, that's dependent on those companies being really good at selecting where to be around the world, right? So now you've got 50% that's based on the US, but what you find is anytime there's been trouble, whether it's the pandemic or 2008 or go back to 2001, there is a favoring in the US of large over small. Small businesses, right? Main Street business get hit on the chin, get hit on the head from these things. And it's very, very unfortunate because the banks won't lend to them when things are in trouble. And right now, regional banks and commercial banks are still, if you look at the Senior Loan Officer Opinion Survey, which is this phenomenal chart that says, are banks lending or not? Or they make it tougher or easier for their clients to get money? And right now, it's at some of the highest levels we've measured. Actually, right now, it's been this way for like 6 months. And yet,
easiest.
hardest, most difficult for you to get a loan from a bank right now. As bad as it was in 2008, as bad as it was in 91 when 1,000 banks went over the savings and loan crisis, it's really bad right now. The banks, they're so worried about their commercial real estate portfolios, because that's in a Great Depression for another 5-10 years, right? I wish I could say there's some glimmer of hope in commercial real estate. Yes, if you happen to be in data warehouses, okay, that area of commercial real estate is going to probably do very, 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 very well. Yeah. But outside of that, straight up office is dead for another 5-10 years. I'm sorry to say, but it is. So when you start looking at these pockets and you start saying, all right, well, what is the question to be answered? When you talk about jobs report, I'd say, okay, so what is it about the jobs report that you're looking at for what decision? Are you saying based on the jobs report, you should or should not be buying stocks in the stock market? I'm like, this is just volatility in the jobs report. It goes up, it goes down, whatever else. But that is not going to affect U.S. companies' ability to generate record profits this year. They will, and potentially next year. It's looking like it, just based on, we listen to a ton of earnings calls. We listen to management. We hear what they're planning, they're budgeting for next year. It looks like it's going to be a pretty good year, right? Regardless of who wins the election, to be perfectly blunt, right? It looks like it's going to be a good year for U.S. corporations. Right now, people are like, "Oh my God, it's going to be a horrible year if my candidate loses." I'm like, okay, that's a different story. We're talking about investing in the stock market, right? Yep. And whether or not you should. And people being unhappy about, I don't know, Kamala Harris versus Trump winning, right? Either of them doesn't have anything to do with whether or not companies are going to generate more cash flow on some of the safest balance sheets. I mentioned that credit thing, that only 1% of U.S. companies right now has any kind of real default risk, right? Whereas in China, it's 1 out of 3, right? Versus 1 out of 100. So you've got safe balance sheets, you've got solid businesses, you've got record profits, setting up for another year of record profits. What's not to like about buying the stock market? And someone says, is going to throw, well, what about the national debt? I said, well, I'm not buying equity in the United States government, and I'm not recommending you buy T-bills right now either, right? I'm just not. So how is that an issue? So, Tom, when you start looking at any of these issues, whether it's any of these signals and the quality of the data behind the signals, like we were talking about inflation, and I'm like, I don't believe in CPI being the only inflation print that we should be looking at. There's probably 10 different levels of looking at inflation. Rents to me seem like they're still going up. An incredible in inflationary environment, if you want to talk about rents. So it depends on who you are and where you are. But overall, it looks like inflation is getting tamed enough and unemployment is getting bad enough that the Fed will cut rates, right? But even if they didn't, if the U.S. stock market on current rates has record earnings this year and record earnings next year, the stock market's going to be volatile, but it's going to do very well, right, for you. And that's why we're saying dollar cost average in over 18 months. That catches us into the back end of or the beginning of 2026, right? Believe it or not, 18 months from now, we're in the beginning of 26. Oh my goodness, how do you think about that? Right. And so spread it over the time frame. And I think, again, I'm going back to those things, but keep the big picture in mind so that when someone throws this bad news out, you can say, okay, even if I accept it's worse than what it is, the signal, unemployment is worse than what it is, inflation is worse than what it is. How does that affect whatever I'm looking at? And what if I'm looking at is launching a new business in a particular region? That might be bad. If I'm looking at launching office real estate, that is very, very bad.
Right.
If I'm looking at buying VOO and enjoying, right, the 500 biggest and best companies that are going to ride an incredible AI wave that we believe is going to be bigger than the impact of .com, right? And in a similar fashion, 97, 98, you literally had people talking about .com investments. There was an internet industry. And then within 3 years, people are like, oh, this is just silly. Every company's going to have a .com. Every company's going to have an internet backbone. Every company's going to have an intranet that's using TCP/IP and whatever else. And that is what really propelled a massive amount of productivity with U.S. companies and people and led to great stock prices. So the idea that should I be investing in AI companies? I'm like, we're only going to be talking about this for 2 more years, right? Maybe less, because every company will have to be an AI company to survive.
Yeah.
That means consumer companies have to be AI companies and whatever, materials companies will have to be AI companies. Gold mines will have to be AI companies. They'll have to leveraging AI in every way possible to become more efficient in mining gold. It doesn't matter what we're talking about. And so they're saying, it's sort of like back then someone going, oh, I'm investing in the internet industry. And you're like, yeah, right. It's cute. Right now, it's sort of like that. I'm investing in AI companies. I'm like, yeah, give it a little bit. Every company's going to have to be an AI company. And the productivity boom we're going to have for that's going to be massive in a way that the rest of the world won't enjoy the way U.S. companies will. That's another bullish reason, long-term bullish for U.S. stock market, even though I am concerned about a recession and a stock market pullback or some other things happening in the next 18 months, right?
Yeah. Yeah, I mean, again, to understand the nuance of those caveats that you just gave us is really important. To the point of how, let's say, bullish you are on the US, I spoke with Danielle DiMartino Booth recently, and she shared a stat with me.
Yeah, I like her. She's good. We've shared the stage at Stansberry and some other big investment research programs in the last few years. I like her work. It's great work.
Well, the stat that I wanted to bring up was she brought up in 2019, US dollar was 18% of global trade, and now it's 30.
Yes.
And I brought up to her, is this maybe an artifact of the data of people trying to dump dollars, therefore global trade in dollars going up while they're actually trying to offload the dollars. But I mean, consistent with what you're saying, I think that really stands to reason to reinforce this idea.
Yes. So when you think about what she said, and I can't back up the stat, but I wouldn't challenge it because I think she does very good work. So she's saying when you're spending money, right, it's begun from 18% to 30% of global trade. Well, of course, I mean, for so many reasons, BRICS was never going to get off the ground. Russian ruble is near dead. The renminbi, nobody would put their faith into that because the devaluation they're going to need for the renminbi is massive if the country's economy is going to survive as we know it. It may not, right? Because they may refuse not to take those hard hits the way they need. You never know what the Chinese Communist Party will do to make sure their 2 million people are really good at the expense of the 1.2 billion people that are really bad off because of what they do. So when you start looking at that, you say, all right, so that makes sense for global trade, but what about for global investment? Well, we already know that. It's very easy to look at. 60%, right, of global investment in equities is in the U.S. stock market. How do we know? Because the U.S. stock market is bigger than the rest of the world combined, right? When we would start looking at private equity, more dollars go into U.S. private equity than the rest of the world combined. More dollars go into U.S. bonds than almost the rest of the world combined, but certainly a plurality, more than any other region of the world, far more than any other country in the world. But if you say, let's count Europe altogether, it's a little close, right? It's a little close, but still, dollar-denominated bonds are the way to go. Dollar-denominated dividends, dollar-denominated equity investing, venture capital investing, angel investing. At some point, you start saying, all that has to be done in dollars, right? And that's the investment side. And then she's saying on the trade side, it's increasing, right? Because of the SWIFT system and dependence on U.S. Navy for U.S. shipping, for global shipping and whatever else. You can start adding all these things up. And you're like, there is no way, right, in the next 20, 30 years that the dollar is going to be unseated, right? Because of what? Because of a $1 trillion deficit, which could be covered by $50 billion of taxes inside a $5 trillion tax base easily. How is that a threat? No, I agree with her.
So,
and from a different perspective.
Yeah. And going back to what you said about the devaluation of the renminbi, is that because of the real headwinds that, many of these Chinese companies are facing? Like, we've seen Evergreen, we've seen that the housing sector in China has taken a big hit. Are they still working through a lot of those big type of recessionary moves in their economy?
So, Tom, just to make a point.
Yep.
Are they still working through it? We're at inning 1 of a 9-inning game of China's debt crisis. Inning 1. It is atrocious what's going on there, right? The municipalities of China has somewhere between $9 and $12 trillion of debt outstanding, right? This is on the books. You can see this. It's not like this is all hidden information. 9 to 12 trillion, and that's the cities. That's not the federal government. That's just the cities are looking at that kind of, and they don't have a tax base of American taxpayers that have the money to pay that kind of thing off. That is a massive debt crisis of epic proportions that we're not going to see again. I mentioned that Chinese corporations, that 1 out of 3 is at risk of default. That's not getting better day by day. That's getting worse. I think we're going to have a situation where 50% of Chinese companies are at risk of and or potentially in default. You're like 50%, yes, that big a number, right? You're looking at gross unemployment levels that in particular age groups, particularly the youth and new graduates that are in the high, 15, 20, maybe as high as 30% to 40%. It's a problem because the National Bureau of Statistics was publishing a statistic that started reaching 25 to 30+% levels of youth unemployment, and youth being like people in their 20s. And then they killed it. And then it reappeared 6 months later with a new calculation that said, oh, it's only 14%. And you're like, really? You just solved it? They solved it by changing the metric, not by not tracking the fact that they've got massive issues there. So, the political unrest and everything else, it's a problem. China is becoming an island. No country in the world can survive as an island, but that's what's happening. Foreign direct investment into China is at all-time lows. You'd have to go back to Mao Zedong to see lows since 93, 92, right? China's direct investment outside of China is now at like 20-year lows, right? Mao Zedong era is going. So everything Xi Jinping is doing is looking like it's going back to a Mao Zedong kind of era, which means China's looking more and more like a gigantic North Korea, not this Chinese version of capitalism that Deng Xiaoping and other, I'll say, more forward-thinking Chinese leaders had been. Xi Jinping's going opposite and is going all in Mao Zedong, and we know what that leads to, right? It leads to mass starvation and horrible things for the people of China. It's horrible. It's atrocious, right? I keep coming back to China because everyone's always comparing the US versus China. I'm like, so that's China, and that's the number 2 economy in the world. Now let's start talking about what's going on in number 3, 4, 5, 6 with the demographic issues and what's going on with Russia. Russia, prior to the Ukraine war, only collected $350 billion of taxes a year. So US at the time, probably 4 trillion, Russia, 350 billion. Now with all the sanctions and everything else, and even with Russia now just saying, we're just going to take 100% of corporate profits and whatever, maybe they're collecting 200 or 250 billion a year. How can you possibly compete when the US can say, all right, snap our fingers, $100 billion, Ukraine, there you go, right? And they're supposed to compete with that and the rest of NATO and everything else. They don't have the money, right? So you start looking at all these issues and potential devaluations and or hyperinflation. Essentially the same thing, I guess, right? The currency losing any credibility in China and Russia. And what will people do, right? They used to say we can flock to the yen, but the demographic issues of Japan and the problems that the BOJ, the Bank of Japan, is having, I think are difficult enough. Wrestling with it still being an export country and trying to keep the yen, I guess, weaker to make that look better, right? Meaning make that business better. I don't think anyone is putting the yen as their safe haven anymore. So what is it? It's the dollar, right? It's $1 for trade. It's $1 for investment. It's $1 for parking your money, even if you're a sovereign. Well, that bodes well for the US dollar. That doesn't mean I think the dollar is going to outperform gold, right? My goodness, of course the dollar is still going to be inflationary. Of course it is. And of course, dollar should outperform, gold should outperform the dollar like it has for the last 200 years and will continue to. I don't think that's a question, right? That isn't a question. But relative to all the other currencies of the world, will the dollar remain the almighty reserve? Absolutely. Mm-hmm. The evidence is just so overwhelming. So overwhelming.
Well, another piece of that, the rise of the BRICS trading currency that you and I kind of touched on the other day in our pre-chat, was this idea of the actual stewards of currencies that the BRICS countries are, right? You gave me the example of China. They're probably going to have to devalue the yuan. Russia, small size, as you said, of tax base. But the other parts, Brazil, South Africa, and then you have all these other countries that are now joining that, Cuba or I forget the other example that you gave me, are in some ways, I don't want to say insignificant countries, but in the scheme of competing with the dollar, they seem very insignificant, right?
Super insignificant in terms of economic power.
Yeah.
So you add up all those countries' GDPs and you go, oh, that's a sizable amount of the world's GDP. Yeah, add up all those countries' taxability, add up all those countries' corporate profits, add up the incomes of the people in all those countries. It's a disaster.
Mhm.
In fact, not one of the countries that has jumped is a developed market. MSCI for years and S&P and others say, here's the developed markets of 20-something countries, here's the emerging markets, and here's the frontier markets. Well, name all the countries that have joined this BRICS thing. Not one is a developed market. Now, you could argue Hong Kong, but Hong Kong is really part of China, so they should be removed from developed markets. And 700,000 people have left Hong Kong, and as they've crushed any sense of freedoms that are like a constitutional bill of rights, Hong Kong has been collapsing. Interesting to note that as Hong Kong has become more assimilated with China, their economy has collapsed, and people have been emigrating out in droves. As Taiwan has become more separate and less China dependent on trade and everything, look at Chinese stock market. I mean, the Taiwan stock market and how it's been going up, and Taiwan, capabilities. So when you start looking at the developed world, that is all, call it the US dollar driven. And you start looking at 70% of the emerging markets, that remains US dollar driven, and increasingly so. There's a lot of countries that are dollarizing right now. The people are dollarizing, even if the country isn't doing it officially.
Mhm.
And then you look at the frontier markets where their economies are in the shambles, Russia, South Africa, what have you. And you're like, and they're going to get together and create something that's going to be bigger and stronger than all of the developed market rallying around the US dollar. I just like, this is, my goodness, if I was a bookmaker, I'd be like, I'll give you odds on that all day long,
Yeah.
right? Not going to happen. I'm happy to take your money, though, if you want to make that bet, right? And people making that BRICS bet are going to lose money, right? Relative, I'm just saying BRICS currency versus a dollar.
Right.
Now, could they end up with some new trading currency that solves the problems of the ruble? Probably, but all that's doing is replacing what the ruble's losing, right? Could some of the world become more dependent on the renminbi because renminbi steps in, right, for their currencies like, I don't know, Sri Lanka, for instance? Yes, but you're simply replacing whatever was there before that's totally defunct. That's not saying they're replacing where the dollar is. You know what I mean? And when you start looking at that, we're like, all right, so there could be a usefulness of, and you look at all these emerging and frontier markets that have their own currency still, and you're like, do they really have time for it? The country has 3 million people and they have their own currency. This country has 10 million people and they still have their own currency. It doesn't make sense. So yes, there could be some other emerging frontier market agreement that they have, but the trading of that, the investment of that, everything else is going to be tiny compared to the developed markets.
Right. So Joel, what do you see as possible other alternatives to the dollar? Is it cryptos? Is it gold? Like, where do these other asset classes fit in compared to the dollar let's just start with as a trading vehicle?
Well, I mean, I'm very, people ask me, so you're anti-crypto? I'm very bullish on crypto having a place in the world for a means of exchange, for a means of storing value, for a means, where you can do it outside of the banking system. I think there's a lot of good things about that. But at some point, you're going to want to spend that money, or you're going to want to invest that money that's sitting in crypto. And that means you're going to have to invest in the US stock market, or the US bond market, or the US venture capital, or US private equity, or what have you, right? It's going to end up going into those things.
Or go back $2 from whatever cryptocurrency to be able to buy whatever you're going to buy, whether that's a yacht or, let's think big.
Yeah. And that's the point. So imagine you were, I don't know, managing an endowment in Africa, and you had a big university that had $50 million, and your whole country said, we're going 100% crypto. All right. So you're on this new BRICS crypto, and you've got $50 million worth of BRICS crypto, right? And now you say, what am I going to do with it? Well, I want to get a better return on investment. Well, that means US stocks. It's going to have to go through dollars. I want to get dividends because I need to fund my students' tuition, and I need some income from debt. Well, that's all going to come to you dollar denominated, right? It is. I need to spend some money on something. Now, let's say you're a small country. Well, I need to spend on my aerospace and defense. Well, 60, 70, 80% of aerospace and defense comes out of the United States. I need to buy wheat. Well, given the unpleasantness of Russia and Ukraine right now, the U.S. is now the number one wheat provider in the world. I mentioned wheat because wheat is the number one eaten calorie. It's not actually rice. The number one consumed calorie on the planet is wheat, and the U.S. is the number one producer of wheat, right? And so whatever you're looking at, you're like, well, I'm going to need money for my country. I'm going to need food for my country. I'm going to need arms to defend my country.
Energy.
Whatever your country's energy for my country, at some level, it's going to have to become a dollar to get you that stuff you want, the energy you want, the materials you want, whatever else, right? No, not 100%. And that's good. I don't want it to be 100%. But the fact is, people have to just get used to the idea that this Pax Americana is in early stages of becoming, right, this full swing where you start looking at the U.S. being 80% of the world's economies when you measure it using profitability, taxation, incomes, employability, what it does for employment, right, versus something as goofy as GDP. And then you can tell me I'm going to look at a debt to GDP measure and say that's why the U.S. is in trouble. I'm like, well, the U.S. doesn't tax U.S. GDP. The U.S. taxes global GDP. Every time someone buys a Pepsi in India, that results in income to Pepsi company that goes back to the U.S. that the U.S. government gets to tax. Every time someone buys a Tesla in Hong Kong, right, with Chinese money, that becomes profits to Tesla that Tesla then pays some level of tax on that goes to the U.S. government. It doesn't go locally, right? And I could go on and on and on and on about how that works. So when someone says we should look at debt to GDP, I'm like, all right, then use debt to global GDP. They're like, why? I said, because U.S. companies tax the planet. And so that is probably a better measure for the U.S. I wouldn't use that for Finland, right? Where outside of Nokia, all the other Finnish companies are just Finnish companies, right? I wouldn't use global GDP for a Finnish debt to GDP measure. That might make sense. Now for Russia, I would definitely use debt to Russian GDP, assuming you use the GDP number that doesn't come from Rosstat or the National Securities Bureau of Russia, which is giving the most fake numbers. I mean, you can literally see 3 different reports and say these reports have numbers that have been fudged because they don't match. When they start talking about their economy or GDP or whatever else, it's amazing. But someone tried to say the other day that GDP is up and a wartime economy is good for the country. I was like, all right, tell that to the Soviet Union, right? Tell that to North Korea.
So, Joel, how do we think about the differences between how a country might use gold versus how an investor should think about gold?
Yeah, this is at the end of the day, I think gold has been and will be a great trade or a great short-term investment if you're active, if you know what you like about gold, if you know why you're liking gold, if you're following gold supply, money supply, whatever else. I think it's a phenomenal vehicle because you can make money in it. People like, obviously. Let me get to my point. But telling me that if you wanted your money to sit for the next 12 years, should it sit in U.S. equities or gold? 100% U.S. equities, 0 gold. For the passive investor, the individual, the family, they're going to do very, 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 very well with their equity investments just being 100% equities and not having any of that being substituted into gold. All right. Now, if you're holding gold for the next year or two, or you're holding gold for the next 3 or 4 years because it's an interesting trade, and you think it might beat the S&P during that time period in particular, like if we go into a recession, whatever else, I'm like, not a bad idea. Interesting. But you're now an active investor, right? You have to think about it. You have to make time for it. But if you're just a family investor or an individual and you just want to focus on your job, if you just want to focus on welding and say, I just want to focus on being the best super journeyman welder I'm ever going to be and make my money, then my answer is, well, then every month take $2,000 and put it in the S&P 500. That's it, right? In 20 years, you're going to be staring at $2 million. Really? Ta-da! You made $2 million on $2,000 a month. You will not do that in gold. I'm sorry. The idea that you could put $2,000 in a gold and that be worth $20 million, right, in 20 years, $2 million in 20 years, is dependent on a heck of a lot of things happening, right, that are not provable, are very difficult to, you're up for debate. But the idea that you put $2,000 away in the U.S. stock market and in 20 years it becomes $2 million is such a no-brainer passive investment. particularly, and I'm saying U.S. equities. I'm not telling Japanese to do this in Japan. I'm not telling Indonesia to do this in Indonesia. I'm not telling Germans to do that in Germany. I'm saying you're in America and you put your money in U.S. equities, you're going to do very, very, very well over the next 20 years. Right. Very well. Versus gold. Now, that said, how do you think about gold in countries? Well, when every country is looking, Russia, China is staring at their currency, right, going to, heck in a handbasket. Well, no wonder they're turning to gold, right? No wonder they need gold, right, to replace it. And if that creates a demand for gold, an excess demand for gold, that should do well for the price of gold. It's a nice story. It's a nice narrative. I got nothing to say against it. I'm just saying that should be a small percentage of your total portfolio. Your total portfolio should still be mostly U.S. equities for the long term, because over the long term, it will dramatically outperform gold like U.S. equities has for the last 200-something years. For the last 220 years, U.S. equities have grossly outperformed gold, and they will continue to for the next 10, 20, 30, 40 years. Over 3 to 5 years, who knows? And if you're an expert in gold and you think in the next 3 to 5 years, that's where you should put your money, great. That sounds like an active professional gold investor. That does not sound like rank and file families and individuals where some people are saying, oh, you need to put 50% of your money in gold or start storing gold bars and physical silver under your bed and behind your entertainment center. I'm thinking of literal discussions I've had with individuals where I'm like, yes, that is a bad place for it. And no, you shouldn't have it anyway, right? So, I got to just put things in context. Gold versus the dollar, of course, gold's going to outperform. But that's not your only choice, right? As we talked about, there's opportunity costs. And if it could be sitting in the S&P 500 for 10, 20 years, it's going to outperform gold. I'm sorry, right? I've got 200 years of data to back it up and all the reasons to say why the U.S. stock market's going to have another crushing 30 years, not just versus the rest of the world, but in general, because of all the entrepreneurship and venture capital that leads to microcaps, that lead to the mega caps. And you can see that flow just constantly happening in an ecosystem that nobody else on the planet enjoys to that scale, to that massive, massive scale. So no opinion on the gold trade because that requires gold expertise. And I think there might be some great gold trades out there if you're an active gold investor, but that's not passive.
Yeah. Again, lots of nuance to understand. And it never has to be an all or nothing choice, an all or nothing binary choice like that, where you buy no gold and only US equities or whatever. And especially, I think taking a very targeted approach based on rational and objective metrics, I think, as you're saying, is the most important part to this. You were going to add something?
I was going to say, if you were 100% passive investor, all you want to do is focus on your job and throw money into your investments. You do not need gold in your portfolio. I'm sorry, right? If you're 100% passive investor, the second you start saying, I'm going to buy gold because I think some of this gold will beat the S&P 500, I'm like, okay, but you are now an active investor. That means you now have to follow gold. You have to pay attention to gold. You have to start following, gold experts on what to do, when to buy it, when to sell it. If you say, but I'd rather buy a gold miner instead of gold, I'm like, okay, now you got to understand the economics of that gold miner. You got to understand the management. Do you trust management? Are they going to do the right things with it? Do you understand and believe in what the geologists are saying of what's sitting in the mine? Is it possible there's a lot less or a lot more of gold in that mine? This is a lot of work, right? I'm not saying it isn't going to pay off. And that's what Rick Rule's symposium is all about, is that there are some fantastic opportunities for gold mines or whatever that pay off. But when we talk about 100% passive family investor that's simply saying how much money should be in money markets, how much should be in bonds, how much should be in equities, that is the question to ask. And after that, there is zero gold position necessary for someone who's just waiting for that to happen and wants to be 100% passive investor. And they're going to do very, 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 very well over the long haul with that kind of focus on just plain old U.S. equities in the S&P 500. And will likely beat any gold investment over the same time period, any pure gold investment. Now, someone says, yeah, but I invest in this junior gold mine. I'm like, all right, sounds like you're an active investor, right? Wonderful. And if you've got research that de-risks that and gives you a payoff that's 5, 10, 20 times, I'm all for it. But that is active investing. It requires research, it requires time, it requires patience. And that's very different than saying purely passive versus passive with active. Yeah.
So, Joel, what are some of the, let's say, the macro environmental factors that would lead you to want to invest in gold miners?
In a particular gold mine, right? So versus gold miners, but a particular gold mine, I think it's the fundamental research that Rick Rule has done a far better job, and I will speak volumes of kudos and applause for Rick Rule's work and everything else. So I'd say if you understand, the economics of a mine, it's a mill on a hill, if you will. The mill is, what is the productivity of getting stuff out of the hill? And second is, what's the value of the hill? So you've got a sum of the parts analysis. So now I want to be able to understand, is it possible there's a lot more gold in there, in that hill, right? In those hills than people are saying? Do I have some reason to believe that? Do I have a geologist that tells me that? And for some reason, the market isn't pricing that in? Well, that's very interesting. Number two, is there a reason that the production facility or the mill is going to be able to extract that gold at better, cheaper, faster rates and times because they're using the latest in whatever, or they're using sometimes some old methods that are just oldies but goodies and are very cheap, and it's going to get it out, the lion's share of what you need. And if you could do that mill on the hill kind of analysis and you like it, and if someone presented to me that mill on the hill analysis and I believed the person, they said, this is why you'd put money in the gold mine, I'd be willing to say, all right, I'm going to take a 30th, maybe a 60th, right, of my total equity position. I'll sell, if you will, 1/30th of my VOO, and I'll say, all right, I'll put that 3% position into that gold mine. That's a very reasonable thing to do, and it's active. Mm-hmm. Now I got to monitor that thing. Remember, when sitting in the S&P 500, I go to sleep at night. I literally do nothing. I ignore the recessions, everything else for the most part, and in only rare cases would I have to say, should I be selling my investments to buy back in 2 years later, like at the top of 2007 or the top of. But if you don't have a really good financial advisor that knows that stuff when to do it, you just let it ride and you'll still do very, very well, right? So I'm going to take that position out of VOO where I just sleep at night and I'm guaranteed to get my $1,000 a month, making me a millionaire, right? And I want to put a 30th of that into this gold mine. Or if I've got a couple of gold mines, maybe it's a 30th into 2 gold mines, right? Depending on how strongly I feel about the research. All right. I think that's a fantastic idea. Yeah. If you've got the research behind everything else, and that position may outperform. Just remember, at some point, you're going to sell that gold mine, and hopefully you've made a crazy amount of money. What do you do with that money? You put it back into VOO. VOO is your parking spot for that long term for equities. It doesn't go sit in cash where you're now losing money, right? And I don't believe that if you're going to go back and just say, I just got to park the money, you should just put it into plain old gold, right? I don't believe that either, right? Or some gold ETF. And we're saying, no, put it back in the S&P 500 and let it ride there until at some point you're like, ooh, I've got 5 gold mines I want to invest in. All right, take 5/30ths of your equity positions, put in those 5 gold mines, see how you do. But you always put it back in a VOO. That's probably your portfolio management. And I think that gets missed. So many people miss out losing money, not because they didn't make good investments, but because the investment they made was sitting in cash for years prior to the investment and then sat in cash for years after. Or sat in some gold ETF for the years prior and then sat in some gold ETF for the years after. Instead of, no, put it back in a VOO, the best engine we can look at for any 10, 20-year period of time plus.
Mm-hmm. That comes back to that opportunity cost that we were talking about, believing in one thing despite contrary data, maybe.
Yes, sir. Yes. Yeah.
But the question that I asked, Joel, is, are there macroeconomic times where being in gold and or gold miners to you make more sense versus just having an informational or research advantage on which particular miners to be invested in?
Yeah, that it does come to, right. If the government spends $1 trillion above the budget, but that $1 trillion deficit is spent on infrastructure, is spent on the BIL, is spent on creating businesses and business growth, I'd argue that is not inflationary, right? It's going towards business growth and business investment. If you're going to take $1 trillion and hand it to people $2,000 at a time, right? or $100,000 to $200,000. You don't have to pay us back loans at a time. That is super inflationary, and gold is going to do very, very, very well in the coming months and years whenever that happens. And so I'd argue that anytime you see government overspending in inflationary ways, handouts, just handing people money, right, to do with what they will, or loans that they don't have to pay back or something like that, then you would see gold perform well, right, during those periods of time. But if there's a deficit that can be easily funded, which the current deficit can be easily funded, I know it's a scary statement to say, but it can be given the tax base of the US and the profitability and incomes of the people and companies that are contributing and paying those taxes. We don't have such a situation. And I would say the spending and the deficits of the last couple of years have been less inflationary and more production oriented, right? Infrastructure, whatever. But the amount of money that was spent during the pandemic on just absolute BS handouts, of course, you would make a big bet that gold's going to do well. And so that's what we're following. Right now, I don't see a reason to think that over the next 10 years that U.S. equities won't grossly outperform gold, because I don't see the crazy hyperinflation kind of policies coming out of the U.S. government. Remember, a deficit alone is not necessarily inflationary. It depends on what the deficit's for. If the deficit is for pure welfare handouts, of course, you're handing people more money to spend on the same amount of goods. That's inflationary. Of course it is, right? But if you're saying, no, this is for infrastructure that's going to increase production, that's going to increase jobs, that's going to increase whatever over that time frame, then I'm like, well, that's not inflationary. That's going towards production. That means there's going to be more goods and stuff, maybe more goods and stuff than the amount of money that was doled out. That's the idea. You jumpstart those businesses, and then they're on their own. They're off to the races. So, more war, I guess, is naturally good for gold. It's just a quick trade, but war goes away and suddenly that trade goes away. And so that does concern me about investing in gold right now, that Russia is running out of money. They're running out of money. And the best reason that a truce could happen isn't people dying or Russians dying or Ukrainians dying, unfortunately, because that should be the best reason for a truce to war. The best reason right now from Russia's standpoint is Russia's getting crushed by these sanctions. Their GDP growing is an absolute joke. They've converted all the production to a wartime economy, not all, but such a big chunk of it, right? They can't get their exports out. They don't have the technology to keep their wells for either their gas or their oil as good and efficient as they have been, because most of the technology is coming from US or European companies, right? So that something breaks, they can't repair it to work as well as it used to because they can't get the part. They've got to do some kludgy way of getting it to work. So when you add all that stuff together, right, my hope is that we do see an end to the killing, the deaths that are going on in Russia and Ukraine, and that, creates a less inflationary environment. But the fact is, war is inflationary. You're spending money to destroy goods. You have less stuff out there. You have less workers, and you have more money going into the system. So of course, war is inflationary, just as handouts during the pandemic's inflationary. But my hope is that we might see less conflict, frankly, because Russia's running out of money, and that might actually create a knock-on effect of maybe less conflict in the whole region, right? That seems to be sparked somewhat by all this focus on Russia and Ukraine's, problems, which are just terrible.
So then what is the difference between that conflict and the conflict in the Middle East then? Like, do you see that conflict heating up more because, with Iran coming in and all of these kind of threats back and forth, it seems like there's a lot of different incentives involved there than there is just in the Russia-Ukraine example that you just explained.
Well, Israel is certainly spending a lot of money, but not relative to the kind of dollars you're talking about Russia spends in its war machine or China spends in its war machine. I'm not saying Israel doesn't spend a lot on defense, but they've got the money to do it because they've created a vibrant little mini US economy with venture capital, angel investing going to venture capital, funding microcaps, funding unicorn startups and what have you, right? Israel's amazing for having unicorns. Where are they coming from? This phenomenal, vibrant VC industry, again, in a country the size of New Jersey. So they do punch bigger than the rest of all the countries they're surrounded by in terms of their weight. But I'm not going to say I'm the world expert on Middle East conflict and what have you, but it is a lot smaller dollars and things going in. Now you say, well, what if Iran launches a nuclear bomb? What if whatever happens? I'm like, well, those what ifs always exist, and if you believe that's going to happen, that'd be a nice reason to buy gold. Mm-hmm. But that's not as a trade. But that's not a reason to say that the S&P 500 is going to go in a bear market, right? Not if we're going to see phenomenal earnings coming from U.S. companies. That said, I'm still at 18 months, so I don't want people to think back up the truck route right now in the S&P 500. I'm like, no, I think it could be a choppy 18 months, which is why I would say leg into it over 18 months. Yeah. But that's with all these conflicts and everything in mind. Gosh, I hope we see some solutions to this stuff. And if we do, and Russia's forcing them a truce simply because it's running out of money, China, I think, has learned its lesson from what's going on, that they will not anytime soon invade Taiwan. They could destroy Taiwan. They cannot take Taiwan. I think that's a known. Hopefully that means some of these bad actors around the world will stop acting so badly, right? And we can get the world more focused on production and, helping people eat more and be clothed more and have more furniture and home than destroying homes and destroying furniture and destroying textile manufacturing, destroying agriculture, right? Which is what's been going on right now in too many places.
So, Joel, one of the other things that, is obviously very top of mind right now, as well as the election in the US. Do you think that there's a big parity between what sectors are going to do well if there's a Republican versus a Democrat win here in November/January?
Well, all right. So if we're talking about the stock market in general again, and I want to start with that, right? Versus the US economy, they're not the same thing. Mm-hmm. If we're talking about the stock market, the two most important things that happened, right? The two most important elections have already occurred. Xi Jinping, president for life, dictator for life, and Putin, mm-hmm. president/dictator for life. That ensures that the US is going to be the rallying point for all the developed markets. That means countries are not going to take their chances on partnering with Russia and China, given all the madness that's going on there in both of those countries and from their own perspective. And they're going to center around a US-driven financial system, banking system, shipping system, you name it, right? And global trade, everything will center around the world for that. Well, the US stock market is going to do very, very well. US companies are going to profit from that heavily. And so I'd argue those are the two most important ones. As far as the last 4 years, which is the only way I can look to what the next 4 years would be like under a Democrat, Biden has been as Trump on economic policies. He's been strong on tariffs. He's been on other countries. I think Biden actually has issued, under the Biden administration, more construction permits have been issued than under Trump's administration. And I'm talking about construction for oil and gas and the like, not just pure building permits, but construction permits of all kinds. So outside of the Keystone Pipeline, he's been go for it, drill, baby, drill. I mean, it's pretty amazing, right? And so if we're looking at Kamala Harris being a continuation of whoever's been in charge for the last 3-4 years, because clearly it hasn't been Joe Biden, right? But whoever that infrastructure that's been built, Blinken and what you name it, right, mm-hmm. that have been kind of running things behind the scenes. And if Kamala Harris gives them another 4 years, and economically it's similar to what they've been doing for the last 4 years, because I don't think Kamala has thoughts of her own reality on these. If she hasn't told anyone for the last 8 years. But anyway, right? Anyway, so assuming she doesn't, and she'll be part of the machine that's there, that actually bodes well for the U.S. economy. It does. We'll have to see if they're going to overly favor, a certain sector or energy or whatever else. But they're all in on AI. They've been all in on oil and gas outside of Keystone, right? They've been all in on very pro policies, and they've been all in on putting tariffs on China for predatory pricing and dumping. So, and trying to be predatory pricing and dumping on the U.S. And I'm saying this is Democrats, right? What's going to happen if Trump's in office and he says, no, I'm going to go even further on some of these economic policies? These will benefit the U.S. economy in a big way. I think the biggest thing I worry about with the Democrats is if they raise taxes, that's ultimately going to be bad, because The U.S. does not have to raise tax rates to raise more taxes. They need to only sit on the current tax rates and just allow businesses and people to keep making money. And insofar as they do that, and on an increasing basis every year, the government collects more in taxes. They don't have to raise rates. Mm-hmm. But you do hear that from the left and from the Democrats saying they want to raise tax rates. That will be a hindrance on U.S. economy, U.S. spending, you name it, and probably inflationary, because those will probably go more towards handouts versus infrastructure type payments when those occur. Versus if it's Trump, where I think under Trump, we probably have more assurance that tax rates stay where they are, maybe even come down a little bit more, which will be a lot of positive juice for the U.S. economy. Mm-hmm. And will actually, because of the Laffer curve, result in the U.S. collecting more taxes, right? On a lower tax rate, the U.S. can collect more taxes because we're coming down from such high levels, right? Something, the Laffer curve, Laffer should have won a Nobel Prize for that. He did not. It's one of the most brilliant understanding of tax policy is Art Laffer's work. He's still alive, right? Professor Art Laffer. And Trump 100% adopts Laffer's policies. Gave Laffer the Presidential Medal of Honor, which Laffer deserved every ounce of. So that we'd be concerned with. But yeah, we think this is a little bit more of a non-election than, as far as the stock market and the economy, it's a little bit more of a non-election than people think. To the extent that Kamala is just a continuation of the last 4 years, if she were to win. And if Trump wins, it's a continuation of the last 8 years economically. All right.
Excellent, Joel. Well, I want to be respectful of your time. I really appreciate you being so generous with your time here and all of your understanding and your perspective. Is there something that you're thinking about or working on that you'd like to share with our audience to keep in mind?
Yeah, when you start understanding the productivity of the U.S., and I'm going to point to AI not as an industry, but once AI gets seeped in to every industry, to every sector, no matter what, the same for productivity gains and growth and you name it, right? This is not a situation of people losing their jobs. This is, and I had some of my, we've got 150 people, and some people said, "Are we going to lose our job to AI?" And I said, "You will lose your job to someone using AI. That I can guarantee."
Yeah.
So guess what? And suddenly everybody in our firm is learning some AI tool that fits their job, whether they're doing design or they're doing copywriting or they're doing, stock analysis or SEC analysis. There seems to be a proper AI assistant for any of those things. I would tell everyone that the only way to see how AI is going to work is start using AI in your daily life in ways that you have to push yourself to a level of uncomfort. The same way people had to push themselves to, all right, I'm going to order the internet. I'm going to punch my credit card. People are scared about punching their credit card numbers into the internet. Everyone's going to see my credit card as soon as it goes in there. And yet, of course, there has been online fraud, but it's been by and large fantastic for economies. I think what AI is going to do and the way the U.S. is going to overly benefit from AI in everything from how a business, gets its inputs to how it processes the inputs to how it pushes out outputs and distribution, is going to be so radically changing. It's going to be bigger than the productivity of the 90s. And so again, while I'm worried about the next 18 months and the volatility and a soft landing or not a soft landing, what have you, for the next 10, 20, 30 years, the U.S. equities are absolutely the place to be. And we're going to see some phenomenal things. It just, people keep saying, "Tell me your favorite AI stock." I'm like, the S&P 500. Really? That's your favorite AI stock? I'm like, yes, the S&P 500. Right. Not that I don't have a couple of neat little AI suppliers that I like, right? That we would recommend to subscribers. But anyway.
Perfect.
Huh?
As I said, Joel, I really appreciate you spending the time with me to really dive into the nuance of all these things. I think it's extremely valuable to be able to have this type of conversation where we have, if A, then B, with the understanding of the underlying metrics that we're trying to understand the world by, right?
So what you need the data to be cleaner and better, but you need the context of understanding that data to also be there. And so you need the content, but you also need that context. And usually one or the other is missing. You have context, but they have bad data signals and bad content coming in. Or you have this content that is so clean, but they miss the bigger picture. And you really need both,
Yeah, absolutely. So for anybody that's interested, all of your stuff is available at altimetry.com as well as valens-research.com. Of course, we'll link to those in the show notes. Joel, I really want to thank you for your time today.
Thank you, Tom. You do a great thing. Great discussion, man. You really allow your people to dig in, your interviewees to dig in. So thanks, man. If it goes well and your audience likes me or finds it interesting, if they don't like me, have me on again and I'll come back. All right.
Absolutely.
You,
I appreciate it. And, I think as anything, it's going to be polarizing, but I think the valuable part is that it makes us think and challenge our ruts of the ways of thinking about all of these pieces.
I hope so. Very good, man. Perfect. Thank you, Tom.
Thanks, Joel.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.